Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. From soft landing to no landing, bond traders regroup and reassess the Fed's rate path after Friday's hot US jobs report. We'll look ahead to this week's data on inflation. Goldman says surging Chinese stocks may advance another 20% as it upgrades its call to overweight ahead of mainland markets reopening tomorrow. Plus, Israel intensifies airstrikes and ground assaults on Gaza and on Lebanon, 1 year on from the deadly October 7th attacks by Hamas.
Welcome to a new week, everyone. Well, the last one ended with just what the Fed ordered, that surprisingly strong jobs report, casting doubt over a November cut from the Fed, but also casting doubt over whether we will see a landing at all from the US economy, never mind soft or hard. You had the dollar enjoying its best week in over 2 years. The euro dollar currently at 109, futures pointing higher here in Europe. The countdown to the opening trade starts right now.
Monday the 7th. Good morning, everybody. Welcome to the programme. Everywhere you look, there are potential big volatility events. We have a lot to navigate in the week ahead. Think about what we saw Friday, the jobs data. Are we going to get a hot inflation print out of the United States this week? You've got China back Tuesday. The expectation is that we are going to continue to see the bounce progressing from here. Certainly that is the view of Goldman Sachs. We'll come on to that. We've got the Israeli response to Iran still to factor into the energy markets. How does that one play out? And, of course, let's not ignore the fact that we've got jobs as we've got US banks reporting numbers on Friday. That's kind of something that we haven't really factored in, I don't think, kind of a lot recently, is what is going to happen on the earnings front. But, wow, Friday into Monday, massive jobs print. What do we see on the inflation front this week? Should we be focusing on the former rather than the latter? There's so much to think about.
Yeah, there is so much to think about. And you talked about volatility events. We certainly saw some volatility in bond markets on Friday, didn't we, in the wake of that really strong jobs report. So it seems like taking 50 basis points next time, in terms of the size of the cut, off the table by the scale of that move. And we certainly saw that at the 2-year horizon. So 2-year yields showing their biggest weekly increase since 2008. So certainly an incredible move we saw on Friday. Yields climb, no landing, as you were saying, Lizzy. Interesting for me, though, was the fact that stocks went higher too. And I know we're going to speak to Maria Veitmane a little bit later in the programme about this. Yep. But, you know, that good news still manages to be good news, even when we have high expectations about rate cuts. Yeah,
interesting to get the Alarian take, though, that, you know, is the labour market so strong that the Fed's inflation battle isn't actually over? As you say, we'll have to wait for the CPI report. Interesting Thursday, look at the Fed minutes and how hawkish they'll be when they come out on Wednesday.
What was the justification? Actually, do you know, I think Fed minutes are probably the most important thing of the week. Probably the most interesting thing of the week, maybe not the most important. What was the justification for the 50?
Yeah, and we'll get a little bit of that conversation, perhaps.
Out of the minutes. I think it's going to be fascinating. How many reports did you read over the weekend? The Fed's made a policy mistake. They shouldn't have cut aggressively. They shouldn't have kicked off in the way that they have. This is going to turn out to be something that looks erroneous with the hindsight. With hindsight, so many. I reckon I read 10 of those reports over this weekend. There are plenty still that, though, believe that actually the US economy is still slowing down. But you put it all together. You think about what's happening in China as well. You put the US economy that still looks fairly strong together with the Chinese economy that is potentially going to see more stimulus. Goldman Sachs is out with a note saying we see a potential further upside of 20% in stocks. You've got iron ore sharply higher this morning on the expectation that we've got a briefing coming up tomorrow that we're going to be seeing further policy being added into the mix. There are still plenty of skeptics out there, those that argue that actually we still need to see actually details coming through, and what we really need to see is money.
Well, might we see a few of those details? I mean, you mentioned this meeting tomorrow. The China National Development and Reform Committee is going to be talking tomorrow, holding a press conference and talking about implementation of some of these package of measures. And, you know, if you're going to be talking implementation, you must have some of the details. So I wonder if we get some.
Yeah, because remember that February rally completely unwound. So you mentioned the scepticism. You're talking about the likes of Nomura, JP Morgan Asset Management, HSBC Global Private Banking. There are lots of sceptics out there concerned that stocks are already overvalued in China.
Absolutely. But you put it all together and you kind of think about what is happening on a sort of big picture basis. So much going on. And you could also argue that if you take a look at the oil trade, and we've already talked about the iron ore trade, the oil trade has been in part a China short trade. Now you put that together with the fact that we are watching the Middle East so carefully, Lizzie, and it's going to be, again, interesting to see what the inflation dynamic looks like in the commodity space.
Exactly. And oil, of course, opening the week lower as the market waits to see what happens in the Middle East, whether Israel will retaliate. And we have to mention it has been a year since the start of the Middle East conflict, with Hamas killing 1,200 Israelis. A year on, Israel still locked in this multi-front war. No clear end in sight. Israel not having managed to bring home those 100 hostages. More than, it has to be said, 41,000 people killed in Gaza, 1,500 in the Israeli airstrikes on Lebanon, and still no clear solution.
And still over the weekend, we see heavy bombardment continuing of Lebanon. We see troops on the ground in Gaza, more troops, of course, on the ground in Gaza. And the oil story, back to that, the best week since January 2023 last week for oil, as geopolitics really starts to take hold here. But we now find ourselves in a holding pattern.
We do. We're waiting to see what Israel is going to do. Is it going to hit potentially some of the oil facilities that we got a hint that from Joe Biden that there was a discussion about, but then he kind of wrote that back quite considerably. We don't know yet. We're going to wait. We're going to watch. But you put that together with China, you get increasing signals on the China stimulus story. Is that positive for oil? You put in some geopolitical premium as well. How much higher could potentially oil go?
Yes.
We've got all of this to talk about on the show. We've got plenty of great guests lined up for you to discuss what is happening here. Robert Dishner from Neuberger Berman is going to be joining us. We'll talk about what is happening with the fixed income story. State Street's Maria Veitmane is going to be joining us at the Open. She has had a long tech position. It's interesting, Morgan Stanley just out upgrading cyclicals in the United States versus defensives. Commodities covered. We've got Sullivan Capital's Nadia Martin-Vigan on the oil and gas story, and we're going to turn our attention to what is happening with the China story and the metal story. BlackRock's Evie Hambro is going to be joining us a little bit later on, Lizzie.
But look, we've got a busy week ahead. Tomorrow, China returning from the Golden Week holiday, as you say. Wednesday, the Fed minutes. Thursday, US CPI, the French budget as well. Big moment for Michel Barnier. Friday, even more data on the US economy, the PPI numbers at 1:30 p.m. London time. And then, you say, the earnings story. We've got JP Morgan and Wells Fargo reporting on Friday.
Yeah, as you mentioned at the top of the programme, Guy, it seems a long time since we talked about the earnings story and justifying some of these valuations. Well, certainly we'll focus in on the banking sector as we get towards the end of the week. We're going to have a conversation. We'll hear from Jamie Dimon over at JP Morgan telling us his view of things. But so many themes, a lower rate environment, or how much lower rate environment is one of the questions we'll be dealing with. What does this mean for M&A, private equity, some of the IPO activity? Does that seem to be picking up? So we'll be talking about that. Changing capital requirements as well, after we heard from regulators that the banking sector has decisions to make about what to do with that capital now.
Absolutely. But you are going to, I think, at the core of this, you are going to get a better understanding by the end of this week of what is happening in the US economy. You've got the data that we've seen, obviously, Friday. That's the labour market tick. Then you're going to get CPI, PPI Thursday, Friday. You are going to get a look at what is happening with the US economy from Wells and JP Morgan, two massive banks that lend into the real economy. What are they going to be telling us about the state of the US economy? By the end of this week, we should have a much better picture. How much stronger is it than we thought it was? How much more does the bond market still need to price out in terms of this rate cut story? I think that's going to be certainly something that kind of all coalesces by Friday. And
don't forget, that's just the US picture, but we've got lots of data coming on the European front. German factory orders this morning. There's not really a whole lot that this data can do to kind of comfort the fears of a German recession, but we'll get those. We'll get the UK GDP figures as well, which are interesting politically, given that we've got a change of staff at Downing Street.
Got a change of government, basically,
Indeed.
again.
Can we actually see a more positive economic narrative coming up?
Yeah, and not out of Germany, though, because Germany are expecting their economy to shrink by 0.2% this year. This, according to a newspaper over the weekend, but sort of echoes some of the reporting that our team was doing at the end of September. So we're waiting to hear from Robert Habeck, the economy minister, about how dire their own expectations look for the German economy.
We've got a fair few Fed speakers, we've got a fair few ECB speakers as well. It's going to be interesting to see kind of if they completely confirm the idea that we are going to see an October rate cut. Is the ECB behind the curve? Is the Fed in front of the curve? Is the Fed gone too fast? Has the ECB gone too slow? Let's talk about other things you need to know this Monday morning. Here in the UK, salaries increased at their slowest pace in 3.5 years in the month of September. The Recruitment and Employment Confederation and KPMG found an increasing number of candidates and a lower demand for staff, limited wage hikes. The situation was worse for temporary staff, where wages actually fell. Rio Tinto has confirmed that it has made an approach to acquire Acadium Lithium, Rio says the approach was non-binding, and there was no certainty of any deal being agreed. Any potential deal is expected to be worth between $4 and $6 billion. That seems like a fairly substantial spread. Boeing is set for another round of talks with unions later today as it looks to end a 3-week strike by workers in Seattle who are demanding better pay conditions. Unions want the plane makers to reinstate a defined benefit pension plan. The current strike is estimated to be costing Boeing around $100 million per day.
That's certainly an interesting one. We'll continue to watch what happens with Boeing, given what happened with the ports on the east coast of the United States and all of that labour market activity. Rio Tinto confirming then this morning in a London filing, just for London hours, I suppose, their approach to Arcadium Lithium. And we're going to be talking about this later in the programme, aren't we? When we speak, we get a voice from the metals sector. We'll talk to Evie Hambro about where metals are right now. It's incredible to think of something like lithium, which was, seen as so exciting with the EV market, but having such a tough time, on the back of those EV sales not doing too well.
It was London Metals Week last week.
Yeah.
The defining change there was really kind of what happened with China and this big pivot that we're seeing out of China. Iron ore's up again, really strongly again this morning. The anticipation we're going to see further policy action coming through.
So how much of a China bull is Evie feeling right now? How much detail does he have, and what detail does he still need to join the dots? Because it's easy, stocks going higher is one thing, but the real economy and property and construction, that's a very different subject.
It is, but our mine is cheap right now relative to the potential that we could see further down the road. It's interesting that we are seeing M&A. His point maybe is that actually a lot of the listed stocks are cheap relative to kind of where the potential for the metals trade to go is. So it's going to be interesting. We'll catch up with him a little bit later on.
Lots of interesting conversations coming up then over the next hour and 50 minutes. Coming up on this programme, Commerzbank CEO Bettina Orlopp sees risks in a takeover by Unicredit, ranging from a worsening of the credit score, loss of customers and disadvantages for Germany's companies. We will bring you the details from that interview with Handelsblatt later on. Lots of comments by her on the merits and lack of merits of banking M&A. Plus, Kamala Harris kicks off a media blitz with high-profile television and podcast appearances. This after the world's richest person, Elon Musk, appeared with Donald Trump at a campaign rally less than a month from the US election, of course. Up next, we will dive deeper into that US jobs report and look ahead to US inflation data that's due out the middle of this week. We will talk to Robert Dishner from Neuberger Berman. If you have any questions for our guests, please do get in touch with the team that puts together the programme. IB plus BBTV Go. That's the function to use. This is Bloomberg.
The whole report is a superb report. You really couldn't ask realistically for a better report. I still think, as a central bank, you don't want to react too much to 1 month's report.
Austin's impressed. The data coming in good. Certainly that was the reaction to the payroll number from him. Is it a good report for the Fed chair, though? That, I think, is a question that is being asked a great deal right now. Joining us now to try and answer that question, Robert Dishner, Senior Portfolio Manager and Head of Trading for London at Neuberger Berman. Nice to see you.
Great to be here.
Austin's impressed. Austin Goolsbee likes it out of Chicago. The Fed has delivered a 50 basis point cut already, much pushed, it seems, by the Fed chair. Does this data slightly argue in favour of that being a policy mistake?
We don't think it's a policy mistake. The reality was rates were too high, really, relative to where inflation and the economy was. But what we're talking about here is the speed of rate cuts, right? So the market's dialing back that speed and where that endpoint is. The market was sub 3%. That's probably going to settle in more 3.5, those type of things, and maybe that pace gets slowed a little bit longer.
OK, so we go to 25, but should we have started with 25, I guess is the question, because the market, the Fed took us from 25 to 50 very quickly in the quiet period, and the market therefore assumed that the Fed was worried and extrapolated, and we priced in more and more 50 basis point cuts. Should we have started more cautiously, I guess is the question here.
Well, there's two sides to that coin, right? Because when we got the jobs report from July and August, people were concerned we had hit the SOM rule. The Fed should have cut in July. They didn't cut in July. So you can't take one bad report and one good report and say, OK, we're overreacting to both. So I think that what the Fed did was they wanted to get to a place where they felt comfortable, where they can pause if they needed to, where they can continue to cut if they wanted to. So they wanted to get to that place. But the other point which you bring, and you were talking about earlier, the Fed minutes, remember the dots were skewed towards less cuts this year.
Yeah.
Right? So the risk was that we're going to cut less this year than what the market had assumed. So those minutes could end up being a little more hawkish in retrospect.
And where are you, Robert, thinking about the overall economy then and where this takes us? Because now there's talk of no landing. And if we get no landing, are we really going to still need rate cuts? I mean, define it as you like, but how do you see the economy landing?
So, yeah, I mean, the economy is going to land, right? Things are slowing. And, one sort of an underappreciated data point this afternoon is consumer credit. Now, we had a big increase in consumer credit in July. Is that consumers tapping lines because their incomes aren't enough to support spending? We know that can only go on for so long. Those type of things. So yeah, while consumption remains okay, we continue, and why the earnings reports on Friday are really important as well from the banks. Whether it's these big ticket items like autos and these type of things, we continue to hear some concerns along those lines. So the economy is in a good place in the U.S., frankly, but I wouldn't call it a no landing or soft landing. The economy is just sort of that 2-ish%, GDP growth with some risk, on either side of that.
And you made the point in the break, which I think is an interesting one to raise, that in the aftermath of Hurricane Helene, we might not get a very good sort of data picture on the United States in the months ahead.
Yeah, no, absolutely. I mean, distinguishing around the jobs and the employment is really going to be tough for the next couple months. We had that issue back in June when we had the barrel. People, we had some issues around that. So we may not get a good number either for the November report in December, which would be obviously after the Fed meeting in November, or maybe even the December report reported in January. And yet, if you look, obviously, I like using the Bloomberg, the Warp screen, we're priced for 2 more cuts this year. So how is the Fed going to navigate this sort of data uncertainty?
How incredibly on brand. We like it. WIRP on your terminal. But interesting that you think that the Fed's going to stand pat in November, partly because of the election the meeting being the day after the election.
Yeah, no, I mean, the Fed's going to be predictable, right? So if the market's priced for 25, the Fed's likely to go 25. What the Fed doesn't want to do is create any, we're probably unlikely to know who the winner is of the election that next day. About 250,000 or 300,000 people across 7 states is going to determine the U.S. president. So the best guess is the Fed wants to be a non-story on that meeting. So they should be pretty predictable.
And meanwhile, an October ECB cut nailed on?
Look, they should cut. We'll hear more from ECB speakers this week. You mentioned the German factory orders this morning were quite soft. You mentioned the article about GDP being potentially minus 0.2% for this year. We've got the French budget where they may be increasing taxes. So there's just not a lot going right in Europe right now in terms of growth-wise, aside from Spain, which is obviously performing very well. So the question for the ECB is, are they there to support the economy, and what really are the inflation drivers in Europe?
Are there opportunities in Spain, Robert? If Critty were here, she'd be asking, which is why I'm asking.
Yeah, I mean, look, we prefer Spanish fixed income within Europe. We believe, I think French spreads. I think you had it on a red headline the other day. French yields were wide of Spanish 10s. So, one of the things is, go where the economies are performing and avoid those that are not. And the French spread is, I think, a really important warning for both U.S. and, we've seen it in U.K. rates about the role of fiscal. Post-U.S. election, we may get that greater focus on the fiscal.
Is the ECB behind the curve and the Fed in front of the curve? Is that the kind of position we find ourselves with?
Yes.
Okay.
Yeah, I mean, look at what's driving inflation, and you can use, again, staying on brand, use that ECAN function on Bloomberg. So what's driving European inflation? It's American tourists, driving
amazing,
up,
isn't it?
Driving up hotel prices and auto insurance. Auto insurance in Germany is rising like 29-30% a year. That's contributing.
Feels pretty similar here as well.
Yeah. And so, should central banks really be keeping rates at levels due to auto insurance?
I mean, you mentioned the fiscal. If Michel Barnier really goes for it on the tax hikes in his budget on Thursday, do you think that spells more of this agony, the slow agony that Mario Draghi warned about.
Yeah, no, absolutely. I mean, France finds itself in not a great situation given their budget. They were already sort of 6% of GDP. Remember, they got downgraded in May. So they're really in a tough spot here, and really with some tough political governability issues.
And what you mentioned earlier that the focus will be on the fiscal more after the election, and this is sort of this question, I suppose, takes in the US after the election, but also takes in Europe. I mean, what are the things that you're looking for to compare and contrast fiscally in these different geographies? Because in Europe, a lot of the geographies seem to be united by a need to fix budgets.
Exactly, which is why you're going to have slower growth out of Europe. But obviously, we have the UK budget coming up, next month. So, the markets are on sort of, tenterhooks a little bit on the UK budget. The gilts market's the worst performing bond market year to date. It was the worst performing in 2023, worst performing in 2022, and second worst performing in 2021. So, I mean, the market, really does pay attention to these fiscal concerns.
Are you braced for a fiscal tightening here in the UK? Are you expecting a growth slowdown?
Yeah, we do think growth is going to slow here in the UK. There's been some, again, we had, similar benefits from what, we talked about last time, the Taylor Swift shows over the summertime, and it's a real impact, right? And so, but, I'll give you, just an anecdotal example. I went to the NFL game yesterday, right? Go Vikings. And so, but,
you didn't wear the merch.
No, I didn't wear the
merch.
But, my tickets were, probably, for better seats, same price than 2 years ago. So, and frankly, aside from the brokerage fee, they were less than face.
So the fiscal story, the easiest way for governments to deal with fiscal hole is to inflate their way out of it. Are we going to see, is there an element of that, do you think, that is still there? Do you think we're underestimating? We've been told by the Fed that inflation's yesterday's story. Is that a mistake for market participants to assume that that's correct?
We're cautious on it. In fact, we like some inflation protection in the U.S.
Yeah.
Because as you mentioned earlier, there's some crude concerns. Maybe we don't get that growth.
How fat are the inflation tails, and are they getting fatter?
They are. I mean, if we don't get those, they are getting a little bit fatter, right? Because if we don't get that slowdown in shelter inflation in the U.S., if oil does stay high for a longer period of time, remember, gas prices had come in quite a bit in the U.S. And so if those gas prices start turning up, inflation expectations will ratchet up. And again, in the U.S., you have seen a number of strikes. We have the ongoing Boeing strike. We just got the settlement of the longshoreman strike. So we are seeing some of that wage increase starting to filter through. And frankly, although driven partially by a lower work week, average hourly earnings were very strong in that Friday's jobs report as well.
OK, a lot to think about this week. Thank you so much for setting us up. Robert Dishner, Senior Portfolio Manager and Head of Trading for London at Neuberger Berman. Lots to think about this week. We talked about the US CPI print that's coming, the Fed minutes, lots of data points then on the agenda and other reports to look out for. We're keeping an eye on oil as we were just finishing our conversation with Robert there. Down 0.2% this morning, 77.88 is where we trade on Brent. Oil trading lower as the market waits to see if Israel will retaliate against Iran for a missile attack last week. Nadia Martin-Wigan, Director of Svelin Capital, will join us next. We'll talk about the geopolitics. We'll also talk about the OPEC Plus and its reaction function here. To what extent is it going to remain on the same page and able to cooperate? We'll talk about that as well. This is Bloomberg.
Monday the 7th, good morning. 30 minutes to the start of trading here in Europe, 30 minutes to the opening trade. Let's talk about what we are expecting, A, today and B, throughout the rest of the week. Huge events lined up this week for us to think about. Geopolitics, obviously front and centre. We've got China returning tomorrow. You've got to think about what is happening with the earnings picture. The data is also going to be coming thick and fast with a particular reference to the minutes out of the Fed Wednesday. Then you've got inflation data Thursday, Friday. So there's a lot going on here, Anna, in terms of what we're anticipating. At the moment, looks like Europe's going to bounce a little bit this morning. Looks like the US is going to be fairly flat. Yes, absolutely. So we had a chance to respond to the labour market report on Friday here in Europe. So we have done that to some
degree. But it does seem as if we are expecting to go a little bit higher. Is it on that theme? I mean, US stocks remain resilient in the face of higher bond yields. They seem to find good news to be good news, even if that undermined expectations of rate cuts still to come. So that was where we were on Friday, and we are expecting to see a little bit of upside, as I say, here in Europe. But as you point out, Guy, US futures pointing a little lower, down by a tenth or two on E-minis this morning. We will keep bond markets in focus. As I mentioned, the yield story on Friday, incredible. The market's starting to think about whether we get no landing for the US economy. Does that undermine, once again, the ownership case for bond markets? We saw two-year yields really soaring, the biggest weekly increase since 2008 there in terms of the yield on the 2-year. So we'll keep that in focus. Let us pivot to a conversation on oil, though, and what is happening there. As we mentioned ahead of the break, down by 0.3% at 77.81 on the Brent price right now. It's flat to negative this morning as the market is really waiting to see if Israel will respond directly against Iran. And after, of course, Iran's missile attack last week, we've seen plenty of activity from Israel in Lebanon, but focus certainly from an oil market perspective on how they will respond to Iran. This as questions remain about the oil demand outlook, especially from top importer China. Let's talk to Nadia Martin-Wigan, who's Director of Selling Capital and joins us now with a view on energy markets. Nadia, let us think about the geopolitics here and the reaction that we're seeing in markets to that. Things looking a little softer after we did not see any direct activity by Israel on Iran over the weekend, I suppose. Do you think the market is going to, the longer it takes to see any of that kind of response, the market starts to price that out, I suppose, as a possibility?
Good morning. Well, what we've seen since April, for example, if we use that as a comparison, yes, the longer it takes for a response, the more the oil market gets more used to it. However, we see the situation now as much more acute than what happened in April, led by the fact that Israel really started escalations with their pager bombings. Importantly, as Guy mentioned, China is not back in the market yet. They will be back tomorrow. And they've been out on holiday since this really started to escalate last week. So we have not seen any real response coming from that side of the market. And they import 90% of Iran's exporting crude. So it's very important, that relationship right there.
Yes. And Nadia, what do we know about the recent announcements coming from China and what impact that will have on oil demand? Because it seemed to have a very instant impact on stocks. We saw stocks up, CSI up 20% or so since those announcements. And yet the read across into commodities looks a little more nuanced. So what is the link you make between stimulus measures in China and the oil price?
The stimulus measures that have been announced, they're going to take a longer period of time to affect oil markets. So first, we've seen a prop up of the property market and the stock market, as you mentioned. Then we've had big effects in the metals market, in particular in iron ore, which was really being shorted as a way to short China. We have seen, in addition, some shorting of oil as a way to short China, but there are other effects in the oil market that have led to the shorting of positions that we've seen really since July. And that is global demand. It's not only China's demand, and it's, of course, concern about whether OPEC will maintain its policy of maintaining higher prices rather than going for market share. And then finally, it's been extremely volatile in this market, so it's very difficult to trade. So all of that has affected oil positioning, and it's not just China.
Okay. But put China, let's say we take the China short out of the oil price. Mm-hmm. What is a reasonable price for Brent if we basically just put China back on a more neutral footing?
Well, we think oil prices above $80 are healthy for the market. It's healthy for producers, and it's healthy for consumers in the US, in Europe, and in China. So that's a very easy neutral oil price. As we've seen in terms of upside, we haven't had that kind of big demand destruction led by price, even when prices were much higher. When we look at the last data, May and July in the US showed record demand for oil in the US. And that's when things were higher in terms of the Brent and WTI prices. So we can go upwards of $80 as well, maybe at $90 and higher. That's when we start to become more concerned about immediate demand. But it, of course, depends what is going on in terms of interest rate cuts and so forth.
Nadia, how much is geopolitics worth in the current price? How much could it be worth?
Well, we've seen a pop in the oil price, $5 plus in the last week, really. And that, in our view, has been led by short covering, but it doesn't include the long-term, slow-moving trend followers that completely ignore geopolitics. All they're looking at is price signals. And since July, they've been getting a sell price signal. And in the last week, we would say they've been receiving, despite Friday's pop, they've been receiving a signal of hold your position. If something were to actually happen in the market, that's a lot of shorts that really need to cover. And that would start to happen when we're in the $80 range. If we have an actual outage, then of course, it depends what the outage is. Is it affecting Iran's production, Iran's refineries, their exports, Strait of Hormuz exports? There are a lot of scenarios that we can discuss.
Yeah, you talked about the importance of Iran to China, China to Iran, but what about the contagion risk to other Middle Eastern oil producers?
Yeah, so we've seen that production can rise. There's spare production capacity in Saudi Arabia, Iraq, United Arab Emirates, and Kuwait, right? But all of those countries are actually neighbors in the Middle East. Most specifically, Iraq has put out a memo stating that they're very concerned about escalation in the region. Iraq produces 4.2 million barrels per day of crude and and Iran produces 3.4. So it's a much bigger situation. And then Iraq has some of the spare capacity that would need to come in. Saudi Arabia produces 9 million barrels per day, but has 2 million barrels per day of spare capacity that would need to come in if there were an outage in Iran. So it's very much a concern there. And the Straits of Hormuz transport around 16 to 20 million barrels per day of oil. So any closure of that passageway would have much more dire implications to the market.
And even if there is a ceasefire, which a year on seems a long way away, how long would it take for the jitters among, say, the ship owners to calm?
We believe 6 to 12 months minimum, because there's a huge risk to personnel. As we've seen what's happened since COVID, it's been much more difficult to actually staff the shipping industry and maintain good conditions. So accidents like that are a big changeover, would really shift patterns. So we don't expect trade routes to change for at least 6 to 12 months after a lasting ceasefire. But from what we can see, it does not look like either Iran's proxies, or Israel is truly seeking a ceasefire right now.
Nadia, is this a trader's market? Like, how much volatility do you think we're going to see? How many swings do you think we're going to watch over the next few months in terms of oil price of more than $10 a barrel?
We can absolutely see massive swings like this, because when we look at 2025, if nothing were to happen in terms of outages, the market is oversupplied. Right now, we're actually in a balanced market, yet we've already had this kind of price volatility. And that's led by the fact that the market expects an oversupply next year. And so it's very difficult to take on a very bullish position when you have high interest rates that you actually want to hold a lot of inventory in your physical system. So if we take the North Sea, for example, refiners are trading much more hand to mouth because they don't want to have that risk and carrying cost if they overbuy, and then they have to store that oil. So when we look at positioning in the paper market, that's where we've really seen the shorts coming in rather than in that physical market. So I would say it's a very tough market to trade, and that makes it more volatile because you can have this disconnect between the physical side and the paper side. It's much easier when everything is short or everything is long, and then you just trade that.
Yeah, talking of disconnection, Nadia, what kind of disconnect do you see between members of OPEC right now? To what degree do you think they are all pushing for the same outcome or different outcomes?
Well, if we look specifically at Saudi Arabia, they are clearly frustrated with some of the members who are not participating in cuts as they should, most specifically Iraq. But then if we include OPEC Plus, it's Russia, as well as Kazakhstan. Now, Kazakhstan this month will probably be left off the hook because they're having field maintenance. But of course, we have to remember that means they don't have the spare capacity to ramp up if we were to have an outage immediately now. Russia is fighting a war and has clearly shown that it is prioritizing getting as much revenue as it can for its oil to continue fighting against Ukraine. Up until really the last month, it seems, or say 6 weeks, that Saudi Arabia has turned a blind eye to this. But now they are increasingly frustrated. And this is why we keep getting these rumors that Saudi Arabia is going to throw in the towel and start to go for market share.
Yep. Just final quick question, Nadia. Shell this morning flagging weaker third quarter refining margins and a chemical loss. Talk to me about what is happening, not at the barrel level, but at the product level. What is the story there, and how different is it to what we're seeing at the barrel level, at the Brent barrel level?
So on the product side, we have an oversupply of products right now. And the way the market was expecting Q3 into Q4 to go is that we would have huge crude inventory draws to create the refined products we need to get us through the driving season first in the third quarter, and then through the winter in the fourth quarter and first quarter next year. What we've instead seen is a backup of products. And this is what has really brought that bearishness about 2025 also into this year when there's been that disappointment. Importantly, this is why it matters what would be potentially hit within the oil facilities of Iran, because Iran it exports 1 million barrels per day of refined products. So that could help things in the short term in terms of this oversupply. But of course, if that is lasting, then things start to shift. If we take one refinery of theirs, for example, Bandar Abbas, that creates 50% of Iran's consumption for gasoline internally, right? So that could be something that could be more effective towards Iran. But on the other hand, if we start to have a gasoline shortage, then that changes things quite a lot. But bearing in mind China's relationship with Iran, China is has the world's spare capacity for creating refined products. Therefore, if it cannot take in that crude, which is around 1.5 million barrels per day, from Iran, it will need to start buying from other buyers. But they are really looking at that demand for products, and we have to draw those inventories for products first before we get that huge contagion effect.
Nadia, that was great. Real tour de force. Thank you very much indeed. Nadia Martin-Wiggin, Director of Swellen Capital, joining us on what's happening with the oil market. It's like we don't buy barrels of oil, we buy product. And that's where the relation with the consumer starts to come in. We think about the oil price and how it impacts consumer behaviour, but actually you've got refineries in the middle, and that ultimately is the final determinant of what the consumer pays. Gasoline prices have been super low. If we start to see that if we start to see that change in the implications for the US election, for global consumer, for the global consumer demand, so that's where the rubber meets the metal, really. The rubber meets the road in terms of the story.
Yeah, absolutely. So we see how this translates into prices that people see in their everyday lives and start to factor into their inflation expectations, because that certainly then does have a sort of feedback effect. Thinking of the consumer and what consumers spend their money on, not so many of the UbiSoft entertainment games, it would seem, in recent times, given the troubles this business has had. But it's fighting back today against talk of any kind of offer for the business. It's noting the recent press speculation that there has been, and we had a story on this, saying that that Tencent was considering some sort of buyout of UbiSoft. And UbiSoft fighting back today, saying they will inform the market if and when appropriate, says management is currently focused on executing on its strategy. Coming up, we'll take a deeper dive into that UbiSoft story. We'll have that and other stocks to watch shortly. This is Bloomberg.
Enough talk about inflation is dead. Inflation is not dead. enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate.
This is, across the board, a very strong report. If you look in the under components, retail, professional services, education and health services, all significantly beat above their 3-month running average.
I think the Fed should still go another couple of 25s. And then I still think they should go next year. And I don't think you're going to create any instigant for more inflation here. I just think the rate's still too high.
We've been saying slowing but not crashing, and I think certainly the markets and the Fed were very focused on potential downside risks as a result of the weaker labor market reports.
Bloomberg guests they're reacting to the US jobs data. We had that out on Friday. It certainly had an impact on markets. Let's talk about that in 3 minutes. Bloomberg's managing editor for FX and rates, Rachel Evans, joins us now with an update. And Rachel, I don't know whether we go back to Friday or think about what this means from here, but certainly a big re-evaluation of what the Fed does, a re-evaluation perhaps of inflation risks and a lot of volatility in bond markets.
Yeah, Friday's reaction was really quite astonishing. We saw more than 20 basis points of moves in the 2-year. That was the biggest move since back in April, where we actually had a big move up in yields on inflation. So it just shows you kind of how we've shifted from viewing inflation reports to viewing jobs reports as being kind of the big mover in bond markets. But I think that might be about to change. Just given that the report was so strong, it does suggest that there are inflationary pressures still in the market. And that was something that we heard, El Arian talking about, that we've heard Druckenmiller talking about as well over the weekend. And I think that's going to be something that as we kind of head into the CPI print that we have this Thursday, where we'll get kind of that read on inflation, it's going to be very much front of traders' minds. We've seen kind of rate expectations move from being kind of, 60% price for a 50 basis point cut at the next meeting to being less than a certainty that we're actually going to see even one cut at the next meeting. So it really has kind of been a change of mood, I think, over the last kind of sort of couple of days. And investors are really now going to have to think about how they want to be positioned for that.
Rachel, speaking of evaluations, you had the Bank of England chief economist Hugh Pill kind of walking back Andrew Bailey's comments to The Guardian about perhaps expecting a more aggressive rate-cutting cycle. Do you think that this is the beginning of the end for the pound's good year?
I think there is definitely a risk of that, because I think, when you think about what Bailey was basically saying, he was saying that the Bank of England wants to be more aggressive, or would consider being more aggressive, being more activist, if the data allows it to be. Pill was trying to kind of ease off on that, but he's been a lot more hawkish than Bailey has been in recent meetings. He voted to hold rates when the BOE actually cut in August. So I think there is a little bit of moderation trying to come through in Pill's comments, but Bailey really kind of prompted a big reassessment for pound traders. We saw the pound having its worst week since February 2023 last week. And I think that when you look at where the pound is now at 131 to the dollar, it really does look a little bit strong. So there could well be some easing off in the next kind of few days and few weeks.
Why is euro-dollar trading at 109?
Yeah, this is a really good question, right? If we're seeing such bad data coming out, particularly of Germany, what is there to kind of really support the euro? And I think we're still in the midst of seeing this recalibration, right? We've seen kind of the expectations for more cuts in the UK increase. The expectation has increased in Europe as well. We've seen kind of the chance of an October cut really kind of increase significantly. Yep. But we haven't necessarily seen that kind of translate through to seeing more and more easing next year, particularly when we look at it versus the US. At the moment, the ECB and the Fed are practically in lockstep next year, and that doesn't seem like something that's going to be able to continue.
OK, Bloomberg's Rachel Evans, we thank you. Thinking about currencies, we'll switch over to stocks now as we head towards the market open. Joe Easton from our equities team has our stocks to watch. Joe.
Morning, Lizzie. So we're watching at UbiSoft in Paris today. After that massive jump on Friday, the stock was up around 34% on reports of a potential takeover by Tencent and the company's founding family. Now, we put this into context over the past 5 years. We actually see that the stock is down sharply since its pandemic peak, following a string of profit warnings. Also, an interesting note out from Bloomberg Intelligence today, saying that given Tencent's Chinese ownership, there would potentially be some political pushback. And as Anna was mentioning earlier, there has been a statement from UbiSoft talking about reiterating its strategy going forward. Then we're also looking at Rio in the mining space. So Rio is looking at a potential takeover of a US company called Arcadian Lithium. This one jumped around 35% on the news of this in the US post market. This company does battery materials in the EV space, so in line with the energy and energy transition. Now we can see Rio has had a bit of a boost recently, given the lift from the Chinese stimulus, along with the rest of the sectors. Keep an eye on that one in London. Then we've got Richemont finally offloading Yoox Net-a-Porter, this struggling luxury goods online platform. Now they will be looking to potentially write down around 1.5 billion euros worth of this asset. But as we can see from the screen, Richemont, one of the better performing stocks in the sector over the past year to date, given their high-end luxury jewellery is seen as a bit of a defensive part of the market. Then finally, in the analyst ratings, a couple catching my eye today. We've got DS Smith cut to underweight at Barclays in the packaging space. Pirelli, meanwhile, is raised to buy over at Kepler Chevrolet in autos. And finally, Tesco gets a massive price target increase over at Morgan Stanley, which reiterates its overweight rating on the UK supermarket.
Joe, thank you very much. Our equities reporter, Joe Easton. Interesting to look at what's going on in Treasury markets, given the big moves that we talked about with Rachel. And we see US Treasuries, the fall there led by the short end once again. So doubling down, it seems, on, or at least not rowing back on Friday's moves.
It usually takes a few days for the Treasury market to kind of digest and figure out what payroll numbers really tell us. And I think we'll probably take a couple of more days really to work our way through that process, which will take us nicely into the inflation numbers Thursday, Friday, Fed minutes Wednesday. Anyway, markets are about to open. The opening trade is almost upon us. European equities look positive this morning. Details to follow. This is Bloomberg. Monday morning, good morning. Couple of minutes to go until the opening trade here in Europe. It's a big week in prospect. Lots of things to think about, but we've still got the legacy of Friday to factor in to this Monday morning session. You can see that European equities did rise on the back of the payroll number Friday. Risk on at that point. But the US market continued to climb after we had closed. Therefore, it looks, Lizzie, like futures are going to tick a little bit higher.
Yeah, US futures pointing lower, but European stocks having already digested that jobs news pointing higher. Do keep an eye on Germany, the industrials sector in particular, after we had that industrial data earlier, a drop in August. So keep an eye on the likes of BMW and Porsche, Anna.
Yeah, absolutely. Keep an eye on those German heavyweights. Also, focus in on this lot, this list of companies that could be on the move. UbiSoft, as Joe was flagging a little earlier on to us, in focus. After we saw our reporting just at the end of last week, talking about whether we could see a takeover by Tencent, that really moved the shares. The company, though, putting out a statement today saying that they are focused on delivering on their own strategy. We'll see how that moves things forward for that business. Shell is also in focus, refining margins down in the third quarter, they have told us. And they expect to lose money on their chemicals business. This in the wake of what we've heard from Exxon. Just last week, they were warned about refining margins there as well. So interesting to watch that dynamic within these oil majors and these energy businesses. Rio Tinto also in focus. We've seen the shares react a little bit through the Australian session to this. We wait to see how they open in London. But the mining business is going after a US lithium company. Lithium, of course, has been under pressure as EV sales have not lived up necessarily to people's high expectations, Guy.
10 seconds to go. Monday morning, let's talk about the opening trade. Here we go. We're expecting a little bit of upside. Does that fade quickly, though? We're going to watch the opening trade coming through right now. London expected to open higher, but it's going to be only 0.2–0.3%, I think, is the anticipation. As you can see, the FTSE 100 climbing a little. We're up by 0.1%. Keep an eye on the miners. We are looking to the China opening tomorrow. We are looking to this update from Chinese authorities as well. This press conference has been announced, this briefing that's been announced. Is that going to be pro the miners today? So we're up by 0.3% in London. The Stock 600 a little less, only up by 0.1%. The IBEX, though, is up by 0.4%. The CAC up by 0.4% as well. So a positive start for European markets at the get-go of trade, but it feels like we're kind of pricing in the legacy of Friday rather than looking ahead, maybe, Lizzie, to what comes throughout the rest of the week. What is happening below the surface?
Yeah, I mentioned we need to keep an eye on those German industrials after the drop in German industrial orders this morning. We're still waiting for the DAX to open, but elsewhere you are seeing basic resources at the bottom of the basket, lower 0.2%. All but two sectors in positive territory, though. Retail leading the gains, higher 0.5% this morning. Banks just behind. higher 0.3%, but healthcare also in the red, Anna, lower 0.1% this morning.
It does seem that on that basic resources story that you mentioned, the only sector in negative territory then, Lizzie, and it is Rio Tinto that is at the bottom of that list. It's currently down by 0.9%. We've heard about their intentions with regards to lithium product and the market not responding all that favourably. We will get an expert voice, though, on the metal space coming through in around 29 minutes' time. We will talk to Hambro about what he sees in metals, and M&A has certainly been a big theme there. The best performing sector then is around retail. We see some of the usual retail names in there, in that mix. Consumer products and services is also up, but we're not talking about big moves here. I suppose Kering not doing too badly, up by 1.3% this morning.
Is this a China story? Is this the boost to Chinese consumers? You saw Citi upgrading Chinese consumer stocks.
Yeah.
Is this the read across to Europe?
Luxury's up quite nicely. So Richemont's up, LVMH both tracking higher. So that's maybe an indication that is the story. It's interesting that Morgan Stanley's come out this morning and actually upgraded cyclicals and downgraded defensives. But Nestle is, in terms of the points added this morning, the highest. So the staple story is actually doing relatively well, which is interesting. Novo soft, Sanofi soft. So some of the healthcare names are a little bit softer as well, which is worth bearing in mind. Is there a clear theme this morning? I'm not sure there is.
No, we're seeing a couple more sectors drop into negative territory, to your point then, Guy. Healthcare and chemicals, both now pretty flat, along with basic resources, which is down 0.2%. I mean, there is that sense that consumer products are doing a little bit better than the rest, but not by all that much, up by 0.6%. And we look at US futures, and they are ticking down, still down by 0.2%. Let's put this together from an equities perspective. Let's talk to Maria Veitmane, who's head of equity research at State Street Global Markets, and joins us this morning. Maria, very nice to see you this Monday. We're looking for a sort of uniting theme. I'm not sure we have one in terms of where stocks are trading, but big picture, your thoughts post-Friday about stocks, because I think you pointed out in your notes how it was really interesting that stocks managed to rally despite we saw higher yields and reduced expectations of rate cuts from the Fed, and yet this was positive for stocks. What did that reaction in markets tell you?
Good morning. I think the bigger picture is still very, very constructive. So we have pretty much every major central bank and quite a few like emerging market central banks cutting rates. And economies are chugging along, and we're about to get into an earnings season, which is likely to be positive. So I think, broader speaking, I think it is a constructive outlook. We have to be a little bit more careful what are the key drivers. Is it still multiples? Maybe less so, as we're probably not going to get like a lot more very aggressive rate cuts, but direction of cuts is there, and then maybe we look at profits where we're likely to see more companies maintaining their margins, and where we're getting more and more problems. So I think it's overall kind of a balance in terms of drivers, but constructive outlook nevertheless.
OK, I want to home in on that, or zoom in on that earnings story then, Maria, because I was reading some Bloomberg intelligence analysis that says we're now expecting, analysts as a whole are expecting third quarter profitability to rise by 4.7%. That's down from 7.9% in July. So since July, analysts have downgraded their expectations for profitability amongst corporates. And yet you still think that the earnings story is going to be a positive one. What should we watch for?
Yeah, I think there are like a couple of points to make. I mean, normally, when earnings revise lower during the quarter, that's somewhat constructive in the sense that it's a lower bar for companies to beat. So that's probably the first point. So that's kind of a good setup for earnings. But secondly, I think it's really important to look under the surface. And what we are seeing within this 4.7% of earnings growth expectations, we have three sectors where earnings are expected to contract. So it's energy, materials, and industrial. So that's not a good read for kind of industrial manufacturing part of the economy. Financials, about the first report, they expect it to be flat. That's, again, another concern for me, given that investors actually, those stocks have done quite well, and investors are really overweight that sector on kind of expectation of resilient balance sheets. So that's potential concern. And yet again, I wouldn't be myself without mentioning that tech is expected to bring majority of the earnings growth to this quarter. So that's where the strength is still there. So that's an important point for us.
So you're very optimistic. You're very optimistic about big tech in particular. Why can't that optimism be shared to the small caps? Why are you so sceptical about them?
Oh, yes, that's my biggest area of skepticism. I think my favorite chart in my client presentation is looking at proportion of loss-making companies in small caps. It's 22% of in small cap companies that are losing money. That's the third highest level, the other two only being during recession time. So small cap companies are really, really struggling. Within large cap companies and kind of like tech and friends, it's only 3% of companies that are losing money. That's the lowest in this century, so since 2000. So I think that's a real difference. Small companies are really under pressure from economy that is not collapsing, but it's slowing, and it's hitting smaller companies. They have the highest cost of financing. They're selling to consumers that is struggling the most. They're more cyclical. That's where the problem is, and that's definitely the part of the market that's under pressure, not the large caps.
And how much volatility, Maria, are you expecting after the US election?
I mean, I do expect a lot of volatility, maybe not that much kind of driven by election, because I think it's really interesting. So we run this product called Narrative Map in our research, which looks at what major themes are driving the market. And it's really not elections. It's economy, it's Fed, it's labor market. That's where the volatility is coming from. But volatility will be high because, I mean, to me, the key reason for volatility is that investors are crowded into expensive stocks. They've been buying growth stocks, they've been buying quality. That's expensive. So any shock to anywhere, election, economy, payrolls, that's all translated into volatility in the market because, I mean, investors own expensive stuff. So that's the risk.
Maria, what is the risk that the Fed delivers rate cuts and continues to deliver rate cuts at a time when the US economy is doing okay? It ends up providing lots of liquidity, of which there is already significant amounts, and as a result of which we end up in a situation where we get a melt up in stocks, we get a boom in stocks, and then potentially there is the risk of the reverse of that, a bust in stocks. Are we setting ourselves up for that? Is that kind of how high on your radar screen is that risk right now?
Well, I think I really want to enjoy the first part of your journey where Fed is cutting into economy that is slowing but not collapsing. So I think that's what market is focusing on right now. We see investor sentiment is improving. People are buying into it. And I think what Fed is really trying to do, which actually really huge contrast to European central banks, to BOE, which I think investors should really appreciate in their portfolios. Fed is cutting into economies that is somewhat robust. So they're trying to really trying to achieve this kind of, I mean, hard to achieve soft landing, which while what ECB or BOE are doing, they see economies that is quite slow, and so they worry about kind of residual inflation and really not providing enough support. So I think economic outlooks are really different, and I really want to bet for now kind of with US where you're having support of a constructive backdrop, which is really rare, really.
Can I buy Europe to play China?
I mean, no. In one word, no. Because for once, I'm not entirely sure I want to play China. I mean, I see what in China, I see, I don't know, Chinese authorities ordering Chinese stocks to go up and throwing some money to it. They're also really encouraging Chinese consumer to spend. But the jury is still out there. Would Chinese consumers spend? And would they spend on European luxury goods or European goods? Big question mark. I mean, so far, Chinese consumer, we see really very low consumer confidence. The retail sales are really struggling. So we do need to see Chinese consumer to spend. Once we see that, and that would be a massive trade. But I'm still skeptical. Would they spend or not? I mean, they've been bruised by kind of common prosperity, salary clawbacks, and just overall indebtedness. So they're given money. Would they spend or would they save? That I think is the key question to think about. Chinese stocks, medium term, and European stocks.
OK, Chinese propensity to spend. Thank you very much, Maria. Really nice to see you. Have a good week. Maria Veitmane joining us, Head of Equity Research at State Street Global Markets. On to the Core 6.
Let's go. Exactly. Let's go to the Core 6, see what's happening. This is what the biggest, you could argue, most important stocks in Europe look like this morning. We can debate the list, but this is what it looks like this morning. Novo's up, LVMH is up, Ferrari is up, Schneider is up, Nestle is up. They're actually up decent amounts as well. The car sector may be lagging a little. Ferrari's the only major European auto stock to be in positive territory, I think, over the last 6 months. But it's interesting to see a little bit of weakness in the chip space this morning. Let's get some single stock stories that we're not watching on the Core 6 list. Joe's got those. Over to you.
So we are continuing to see a move higher in UbiSoft, guy up around 5% in Paris this morning. Bear in mind, in the context of that 35% gain that we saw on Friday on the Bloomberg exclusive around Tencent and the founding family of the company looking at a potential takeover, a buyout of the firm. Now, we have had that statement in which they say that they are focused on their strategy and will update if any new information comes to them. But as such, we are still seeing that gain extending in Paris this morning. Then in terms of Italy, there's a bit of M&A over there as well. Italgas doing a deal for a big rival there, potentially including debt. This is worth around 5 billion euros, so more than its own market cap. So a little bit pricey perhaps on that one, but that stock managing to still gain around 0.5% today. Then staying in Italy, we've got Nexi reportedly agreeing a contract extension with Unicredit. This is the big payments firm, payments processor over in Milan, up around 1.4% on that one. A bit of positivity coming through. Then in the commodity space, an interesting one. First of all, we've got Shell on the production update. A lot of that looked slightly weak, in fact, but potentially just moving with the broader market on that one. And we were also looking at some of the mining stocks. We'll take a look at Pirelli, upgraded over at Kepler Chevreux. Now, Kepler does actually downgrade price targets across the auto space today, but it likes Pirelli as a potential standout for that one. Then going the other way, Bank of America becoming more negative on EU software today. They downgrade Alten and a bunch of other stocks. That one's listed in France, and we're falling 3% there. And then a breaking news on the rating changes for Neste. This one is coming down at Exane. BNP Paribas, they go underperform on that one, saying the renewables margins are weakening. That one declining over in Helsinki today.
All right, Joe Easton from our equities team, we thank you. Anna, I did say that we should keep an eye on the German industrials. The DAX is open now, flat to the downside. You've got Mercedes, BMW, Continental, Siemens Energy, all in the red after that drop in German industrial production. But Daimler eking out gains this morning, as is Porsche. And as a sector, industrials and goods and services up 0.25% across Europe.
The car set, we're waiting for the Chinese response, aren't we now? We're going to...
There were some words, weren't there,
the European authorities announced, well, we had the vote last week. Europe is going to go ahead with these tariffs at 45%. How do the Chinese respond, and how does that affect particularly some of the upper-end German car makers? I think that's an overhang for the market in terms of some of these car stocks.
Yeah. Absolutely, we'll continue to watch that. Coming up on the programme, Commerzbank CEO pours cold water, talking of Germany, on any potential merger with Italy's Unicredit, warning a deal could cause more headaches than it's worth. Details next. This is Bloomberg.
Monday morning, let's call it 18 minutes into the session. This is what the picture looks like, as you can see. Not much action, to be brutally honest. There's a lot of unch kind of effectively being demonstrated on the screen in front of you. It is a huge week, though, coming up. Feels like we've kind of priced Friday. We've done a little bit of that. We've faded that. We're now looking at US futures. We're a little negative. We've got so many risk events coming up throughout this week. It's going to be fascinating to see which one has the biggest impact. Let's talk about some of the single stocks that we're watching this morning. In an interview in Handelsblatt, Commerzbank CEO Bettina Orlopp says that she sees risks in a takeover by Italy's Unicredit. Some are questioning whether or not this is cross-border mergers, whether Unicredit is really that Italian. Orlopp adding that any potential deal could lead to a loss of customers and create disadvantages for German companies. Let's get the details of this story. Bloomberg's Ollie Crook joins us now. Why so negative, Ollie? She's coming out with lots of kind of negatives as to why this deal wouldn't happen. What I'm not hearing are a lot of positives as to why Unicredit would be better off as an independent company.
Yeah, well, listen, Guy, that was for a couple of weeks ago in terms of giving the sort of positive vision of the future that she's got for the bank, and she laid out her kind of 3-year plan for that, a couple of weeks ago at that Bank of America conference, which really turned into the sort of Unicredit Commerzbank show. But right now she's sort of highlighting in her first interview she's given since becoming CEO all the risks that are associated with it. And really she sort of leads with one that is very close to the sort of German heart, which is creditworthiness, saying that this could be a major sort of hit to Commerzbank creditworthiness. Another thing that she highlights is because of some of the overlap with the other bank that they own in Germany, they could have to shed some clients. And also talking about basically the fact that if they don't have the headquarters in Germany, that in times of crisis, as you could arguably say that the German economy is in right now, that the decisions that are made that are far away from the economy are not really for the sort of best interest of that economy. Now, of course, she has then gone on to say that basically the only sort of path forward is her plan, that 3-year plan, which requires Commerzbank to remain a standalone entity. It is all about boosting profitability. What I found was interesting in this interview, though, is that she was asked at what price does this deal make sense. She wouldn't answer that, but she said that she was confident, and you can see the share price on your screen is at about 1670 right now, that she could get the shares up to 25 to 30 euros a share. Guys, that has not been a reality for Commerzbank since 2011, as sort of at the most recent time, and that is some distance away, and that is with this Unicredit sort of premium that's already priced into the shares right now.
So that's the Orlopp side of the argument. What are we hearing from Orchel on the Unicredit side of the argument?
So listen, he spoke to The Economist over the weekend and really sort of making some of the same points that he's been making throughout, those sort of pushing back on some of the issues that we've heard from the German government, saying that he had been totally transparent about this, that he has sort of taken the Germans sort of agreeing to sell it to him as a sort of tacit sort of green light to move on the bank. What I also think is interesting, though, is he did highlight that the fact that there is not a huge amount of overlap between the current clients within Germany and Commerzbank, and that there are synergies there. Critically, though, what I thought was interesting is making the case to the public that any sort of takeover or merger would not lead to huge amounts of branch closures and job cuts. He was saying that if there were going to be any job cuts, it would really be at the management level and the headquarter level, but that he would, largely speaking, keep the branches and so are lower levels alone. Does that bring enough confidence to move the conversation forward a little bit? I'm not so sure.
Ollie, thanks very much. Bloomberg's Oliver Crook joining us from Berlin. Let's check on another corporate story that we're keeping across today, and that is UbiSoft. The share price of UbiSoft up by 3.4% after a stunning rally during Friday's session. UbiSoft saying this morning that it's focused on executing its strategy after Bloomberg has reported at the end of last week that Tencent and the founding family of UbiSoft are weighing options, including a potential buyout of the French video game developer. There you see the share price move today. That on the back of a very strong move during Friday's session. Let's bring in our deals reporter, Manuel Bagori, who can take us through some of the detail here. So, Manuel, why would Tencent make such a move for UbiSoft?
Hello, and an interesting move indeed, and a rare one, because we haven't seen a lot of cross-border M&A from China recently, especially with big tech companies laying low for quite some time. So definitely one that would make sense given where the share price at UbiSoft has been trading at lately. I mean, keep in mind that shares of UbiSoft have plunged over the last few months more than 50%, all the way to Friday after or before our scoop, better say. I mean, it would make sense because it's kind of like giving them a foothold in the gaming industry in Europe. It's an interesting proposition, one that they know they've been partners for quite some time, and they would be potentially doing it with the family, so ensuring that the current talent at the company remains in place. So we make it definitely for a good transaction for Tencent potentially.
Manuel, just talk to me about who else could be interested. There's talk that private equity could be interested. There's talk that KKR, that Blackstone could potentially be circling as well. What would they offer that would be different? And to what extent is the current transaction that's being talked about a defensive move?
Yeah, that's a very interesting point, Guy. I mean, it's one that has been talked about for quite some time. The company has been struggling. They cut the guidance for earnings recently as well on the back of some delays for some of the titles, and they've been under pressure. I mean, some of the minority investors have been very vocal about the company, pushing the company to explore options, either a take private or a sale to a strategic investor. And as you well said, some of the private equity firms in the industry, the biggest ones, have been circling around. I mean, definitely it's a company, an interesting case study for for a go private deal and see if they can continue to grow the business without the pressure of the public markets. Whether or not Tencent and the family or ultimately another buyer shows up remains to be seen. Our understanding is that there is a lot of options on the table to try to maximize value at the entity right now.
Thank you very much, Manuel. Deals reporter Manuel Bagori with the latest on UbiSoft. More corporate news flow. This also in Paris, in fact, Atos. Now, we know that the tech business, the IT business has been struggling for some time, has been in conversations with the French government and putting out a statement today, just reminding us essentially that those conversations are ongoing, saying that the confirmatory offer that they had from the French government has now expired and no agreement was reached. But they've sent an alternative proposal to the French state, it seems, to try to continue those discussions. This is something of a strategically important asset, it would seem, in the views of the French government. There's
a defence element to this, so they've always been very kind of interested in what is happening here. So, yeah, I think the French government will be paying a great deal of attention. What is a strategic asset for the French, though? I think is an interesting question that always seems to come up, Lizzie.
Yeah, and it comes in the week that we, of course, get the French budget. Michel Barnier delivering that on Thursday, which comes, of course, at a time when France is really struggling to tame its deficit. The politics are an absolute mess. I feel like his new job makes his Brexit negotiations look like a doddle.
Well, he's had good prep, hasn't he, for all the struggles and all the trying to corral people onto the same message, which he's going to have to try and do to avoid some sort of no confidence. I mean, the fact that Le Pen has not pushed that button is material, I suppose, but she seems to be somebody to watch on that front.
Yeah, it's going to take longer. It's going to be harder, seems to be the message. Is France going to have to deal with austerity? Is France ready to deal with austerity? And once the reality of that bites, how does the French population feel? Is Le Pen effectively... She's not focused on this story right now. She's looking ahead. She wants the presidential election. That's what she's got in her sights right now. The more chaos, the more trouble, the more pain, you could argue, maybe augments her efforts as she looks to maybe take the Elysée rather than taking the prime ministership. I think that's the question that everybody's watching in France so carefully. What is it? Where is this going to take us in France, and how is this going to change the politics?
Yeah, and at a European level, as I say, does it lead us more towards that slow agony that Mario Draghi set out in his report? But coming up on the programme, it is 1 year on today from the October 7th attacks on Israel by Hamas. We're going to bring you the latest from the region and, of course, the impact on the oil price. We do have Brent currently starting the week higher now at $78.49 a barrel. We'll go to the Middle East next. This is Bloomberg.
"30 minutes into the Monday morning session, this is what the picture looks like. So the initial bounce, which was basically kind of a little bit that we didn't price in Friday from the payroll story in the States, has now faded. As you can see, we are coming a little bit softer. There's a bit of red on the screen now. It's a bit of M&A in the market as well that we need to be factoring in, and that is meaning that the basic resources sector is the worst performing sector. It is down by half of 1%, and Rio is doing some of the damage in that space. This after we have had confirmation that the mining giant has made an approach for Arcadium Lithium. The move confirmed the speculation over the weekend. Everybody's turning their back potentially back to growth, to M&A. Seems to be a theme. Major miners looking to increase their exposure to the energy transition metal story at a price that now seems much more reasonable. Evie Hambro, who is the head of thematic and the sector team of BlackRock Fundamental Equities, sitting around the table, something of an expert in this space, and he's now fully recovered from Metals Week, which took place in London last week. Nice to see you.
Morning, Guy. Thank you.
Everybody's getting very excited about a China briefing tomorrow morning, that we're going to be seeing maybe some money put behind the words, and that this could give a further lift to some of the metals. We've seen iron ore up quite decently overnight. Is the China story real yet to you? Do you feel that this is something that has got legs? Do you think the Chinese have changed their attitude, and what does that mean for the metals market?
Yeah, I mean, obviously the timing that we had on that initial kind of burst of enthusiasm towards China with all of the announcements really kind of set the LME week kind of gossip channels running as hard as I've seen. But you look at some of the patterns in inventory moves and so on ahead of that, and they were pointing in that direction anyway. So, at the end of the day, China has been weak. There's no doubt about that. The world's largest commodity consumer. But they've been weak in the context of the world's largest consumer. Yep. So actually, the consumption's been going up in many of these areas. It just hasn't been going up at the kind of exciting levels that people would have thought about. So, you look at like copper, we've got, decent levels of copper demand growth going through, steel, iron ore, etc. Look at some of the industrial metals outside of that. It's not a bad picture at all. So if we did get anything substantial from China, it's like we're kind of elevated even further and tighten markets. And that's what we've been thinking about for the last year. I mean, there's been this negative sentiment cloud that's been overhanging the commodity markets that's allowed them to kind of drift. And if that's removed by what China's doing, then it's a pretty exciting time ahead.
If that's the case, do metals equities, do the miners look cheap?
The miners look cheap, full stop. We don't need the China situation to dramatically improve. You've got valuations today that are way below their long-term averages. You've got very, very strong balance sheets. You've got good levels of margins across most commodities, with a couple of exceptions. If we did see some extra demand then in a tight market, that'll lift prices. And if it lifts prices, then the profitability will go up even further. So we've been positive on the outlook for equities. It's been an up year. Yep. It hasn't been a massive up year. Nothing like as much as we've expected. But take copper for example. The price peaked at $5 and a bit a pound, earlier in kind of May timeframe, got down to about $4, and now kind of $4.50, $4.60, back through $10,000 a ton. That's a pretty healthy price.
Mm. And what about this story? And Guy mentioned the story around Rio, and that seems to be, this morning, the news flow that seems to be driving the sector. And I wonder what that tells us about M&A and animal spirits. You've just been at LME week, and I wonder what you picked up on that theme and what this tells us about the sector and where we are.
Yeah, I think that there were a lot of takeaways from last week. I think the first thing is that and it's incredibly clear when you look across the valuation space, is it is much cheaper to be able to go out and buy than it is to build. You look at the capital intensity of building new production today, it trades way above the valuations that we see in the market. So it's no surprise to us to have seen these kind of animal spirits in the context of M&A, running for most of this year. We've seen a number of, transactions attempted. Nothing as yet kind of concluded in the bigger space, but I don't think that's going to go away. And recent examples just kind of highlight this trend. In the lithium space, lithium prices were a lot higher a few years ago. So to try and take advantage of them at lower price is probably more sensible than buying them at the higher price. But the outlook for the EV space is tough. You've seen lots of downgrades coming through there, but if we fast forward 2, 3, 4 years into the future, which is often longer than most people's investment horizon, and these big companies have to think in that much longer horizon, it could be a sensible thing for companies to take advantage of weak pricing.
Do you think lithium prices have bottomed then, given what we've seen in EVs?
Yeah, well, we're starting to see production growth plans deferred, which is a signal we always look for. We're seeing the prices trade below some of the marginal costs. We're into the cost curve, so we're seeing some production being turned off as well. Yeah, those are signals that you would typically look for when that marginal cost production is coming out of the market. Then you do start to see prices level out, and I guess we need to see demand come through to lift it for higher from here.
I mean, you say it's cheaper to buy than to build. Do you think actually more investment is coming? And if it is it going to be too little too late, given the time lags it takes to filter through?
Yeah, I mean, there are so many challenges with building stuff. The risks are absolutely enormous, and they get more every year. The delays around ESG that we've now got to factor into all of this, the permitting timeframes, actually finding the stuff. The exploration success story has been pitiful for many, many years across the industry. And so there are huge, huge challenges in building stuff, let alone the cost. I mean, you look at the capital intensity today, the amount of money that's going to be needed to be invested is way bigger than these companies can afford. And the other thing you have to think about, this sector is so relevant in all of our daily lives, but everybody takes it for granted. We think that the commodities are all here, we're going to be able to use them, we're going to be able to build the stuff that we need. The market cap of this space is less than the daily moves of NVIDIA. It's just extraordinary. I mean, look at some of the supply companies to the mining companies. Their market caps are dramatically bigger than the biggest mining companies. Yet, we can't do the stuff we want to do with regards to whether it's energy transition or whether it's the AI investment needs. We need raw materials for that.
Well, yeah, at how much of a boost do you think you will get from AI to the metals sector? You think about building data centers. Surely that's a safer bet than where you say about the, uncertain outlook for EVs.
Yeah, so I think when you think about the growth prospects going forward from here, the drivers, a few years ago everyone was talking about energy transition, how much more materials we need to replace fossil fuels and so on. Now people are talking about AI. But, when you look at the kind of the details beneath those, that's all about materials. You can't build an AI center without the copper and everything else that's going in. So what we're doing is we're adding layers of additional demand onto the market that need to be accommodated in supply growth. The supply growth only comes with investment. And as you've just said, it takes a long time to build new capacity. It takes an enormous amount of money. There are many hurdles to getting that stuff built. And if we're just adding layers of demand and we're not making the investment into supply, then there's going to be a gap that opens up and it's going to put pressure on prices.
When does the market recognise that? Is there a kind of moment where the market goes, we've mispriced this stuff?
Yeah, I think we've had flashes of recognition over the last few years. We've had these kind of brief points where things have really started to move and everyone's got excited. We've had M&A that's kind of been signalling this as well. Yep. But there isn't the kind of widespread consensual view. There's still complacency when it comes to supply. And I think that, it's because, you look at our daily lives. How often do you realise that you're consuming copper? Yeah. You're consuming food and petrol and everything because you see it. You know what the price is. It affects your wallet. But, you don't know if the price of steel's gone up unless you're building a house or copper or whatever it might be. So there's
petrol, gasoline's easier to understand.
Yeah, it's just visible. Absolutely, it's visible. You just don't see it. If you're the average consumer, you don't see it. So I can totally understand why there's this complacency, and therefore that complacency means I don't care about it when it comes to my investment portfolio.
Can I ask, then, you're sounding really quite bullish then, Evie, on these stocks. Why is it so we see, for example, Rio down today, and I know we won't focus necessarily on one particular deal, but even at a time when you say there's lots of good value around in the sector, when we see some M&A, there's nervousness perhaps that big names overpay. How nervous should we be about overpaying if things are such good value?
Well, the track record on M&A hasn't been great in this sector over several decades. And it also hasn't been great, and we saw some terrible examples in the early 2000s, and again some more terrible examples from kind of 2011 through to 2015. But I think since 2015, end of 15, beginning of 16, the capital discipline and the capital allocation frameworks that the companies have put in place have given us much more confidence that the money would be spent more wisely. And we've had now, whatever it is, the best part of a decade of you could say kind of austerity. There's been discipline. The companies have been paying down debt. They've been handing cash back to shareholders in dividends and in many cases buying back shares. You've seen an enormous reduction in the share count across many of these groups. And so when you put all of that together, it's been surprising to us that we haven't had the spectacular returns that you would get. But the returns have been very good since 2015, much better than the broader market. Now we're kind of starting to see this inkling of M&A activity, and I think that there is obviously caution around that because when you see M&A transactions normally announced, the acquirer's shares normally go down on the initial day, and in some cases they go down more than the price or the value they're paying for the company they're looking at. So it's not a surprise to us to see some kind of initial reaction. Also, when you have M&A, it needs to be explained, and I think with the examples you're talking about, there's been very little commentary from either side.
Evie, I know that you're a metals man, but I'm looking at WTI up more than 1% currently. We've had even equity traders dipping into the oil market to take advantage of the war risk. How do you observe that from where you're sat?
Well, it's a tough area to go into geopolitics when it comes to this, and obviously there's multiple tragic situations happening around the world. So it's no surprise to us to see when you have this heightened risk that premiums do go into commodities like oil. So I think that's a natural reaction that people will be looking at. But when you look at the physical situation in the oil market, it's actually pretty weak with regards to demand. The contraction in growth assumptions around Chinese consumption are very, very material. And so unless we see some kind of response from OPEC to be able to protect prices without the kind of geopolitical risk, you would expect prices to retreat back down again.
Can I just compare and contrast the lithium story and the oil story? We got very excited about EVs. Lithium absolutely surged, has faded. The expectation on EV transition is now much lower than it once was. Battery transition was lower than it once was. If we see, for instance, the European Union pushing out dates for the transition towards EVs, how does it change? Does it change the calculus around kind of how the energy transition is happening? Have we set ourselves too aggressive targets. Are those too aggressive targets now being downgraded? Have they been downgraded in terms of things like the lithium price? Is oil demand going to be with us for longer? How do you see that balancing act between kind of old world hydrocarbons, new world metals electrification?
Yeah, well, I think there's multiple fronts in the way you could answer that. So when you think about the move away from fossil fuels, it's not just in petrol. You know, it's across the entire energy space. And so when you think about the environment we're going into in regards to energy consumption, we're going into an area where we're going to have a higher level of energy consumption per unit of GDP, which is very different to the energy levels of consumption we've had in the past.
Right.
It's been pretty static. And so if we do start to see this digital growth coming through and driving higher molecule consumption, you've then got to think about the format of that molecule. How is it coming? What's it being generated? Where is it being stored? How is it being moved around? And if we're moving away from fossil fuels, then we have a higher materials intensity in that higher energy environment, which is very exciting. EVs specifically, we have seen downgrades with regards to production numbers and sales estimates, but actually the amount of the penetration rates are still high. We're seeing much higher, and you guys are the expert, your BNEF colleagues are just superb in this regard, but we're seeing much higher rates of market share than even the most bullish people were expecting. But what we've seen is the customers, they're saying, we want value. And the prices of cars that are now coming in to the European market specifically, are incredibly good value, hence the tariffs that are being put in place. So I think we're in this kind of, this kind of price discovery process when it comes to things like EVs. What can the market afford? The perceptions on risk around the reselling value is a huge factor. We've seen obviously a collapse in electric vehicle prices in the second-hand market because of the uncertainty on the batteries. And so, those factors need to come through, and we need to start to kind of get through this point where people start to build comfort. And I think once we've got that kind of level playing field, the EU is trying to put in place, then we will see probably a market that goes forward from there.
But we need a little more time.
I think we do.
Price discovery process to unfold.
This is new. New stuff takes time for people to get used to, and there's been a lot of uncertainty around this, and charging infrastructure is playing catch up with the number of vehicles on the road. So all of this needs to happen, and we've also seen huge improvements in the technology as well. I think we're going to see a step change in battery performance.
It's good to see you. Thanks for stopping by.
Thank you very much for having me. Absolutely. Thank you.
Evie Hambro joining us from BlackRock.
Let us stick with the commodities theme and head back to the Middle East, which is the conversation we started having earlier on in the programme. As the Middle East marks 1 year since the October 7 attacks by Hamas, Israel is locked in a multi-front war. The IDF sending troops back to northern Gaza and keeping up an intense aerial bombardment on Lebanon. For more, let's speak to Jumana Besetcha, our Horizons Middle East and Africa anchor, who joins us now and casting her mind back over the past year, Jumana, and forward to what happens next. 1 year on then, is there any end in sight, Jumana?
Well, that is the question. And of course, we cast our minds back to the events of 1 year ago, a deeply traumatic event for Israel, and the single deadliest event to ever occur on to the Israeli nation. And since then, it has been a game changer for how Israel views its defense and how it views its place within the region. The goal ever since has been to ensure that an event like October 7 never happens again. And so the events, if you look back at what has happened just over the last 12 months, Israel has launched a massive military campaign against Hamas militants within the Gaza enclave, but it, of course, has come at a very high cost. The Palestinian Health Ministry state that 42,000 Palestinians have lost their lives, 90% of the population displaced, 60% of the city has been destroyed, and yet still about 100 hostages remain in captivity with no ceasefire in sight. And it's not just the one front that is being waged there. Another front has recently become a lot more intense over the last couple of weeks. Here I'm talking about the events in Lebanon, with Israel launching a ground incursion with the stated aim of dismantling Hezbollah military infrastructure. And that has only intensified over the last couple of days as well, with ongoing airstrikes aimed at some of those key Hezbollah strongholds around central Beirut and around the eastern Bekaa region close to the border as well. And that is, of course, one other front. And then the third front, which potentially could be the riskiest of all, is the second episode of Iran firing direct ballistic missiles at Israel a week ago. And the expectation is that Israel will have to respond in the coming days. And so if you look at the events and everything that has unfolded over the last 12 months, there hasn't been a lot of de-escalation. If anything, it has been escalatory in nature, and still we talk about the potential for a ceasefire, but there appears to be a lot of daylight between all of these sides as to whether or not those ceasefire can be fully implemented and respected by all parties involved.
Well, Jemana, as we question what's left of America's influence over Israel in Joe Biden's final months as president, as we await a potential Iran reprisal, what are the latest developments in Lebanon?
Well, the Lebanon is probably the most intense front, and I listed that it's a multi-front war, multi-front conflict going on in the region right now. And in Lebanon, you have airstrikes that are continuing in central Beirut, South Beirut, the eastern Bekaa. Even one of the crossings, the major crossings from Lebanon to Syria, was hit with an airstrike over the weekend as well. The death toll is rising there too. The number the Lebanese Health Ministry have put out is 2,000 people have lost their lives, around 400 of them women and children, about 100 medics also targeted as well. But then there's also fighting going on the border too. And it's unclear at this point exactly what is happening. It's quite difficult to get information as to what is happening with those border clashes that are still very close to the southern blue line, as they call it, the border that separates Lebanon from Israel. But per Israeli media, about 10 Israeli soldiers have lost their lives. The IDF have also said that they've been successful at dismantling around 2,000 of Hezbollah's military infrastructure sites. And per IDF as well, so far, given the intensification of the campaign in Lebanon, they say that they have dismantled 60 to 70% of Hezbollah's total arsenal. But the question from here onwards is, at what point does Israel see themselves as having completed that new war objective, which has a stated aim of restoring security back to the northern border again. And on the other side, on the Lebanese side, again, no end to the airstrikes in sight, coming at a time when there is a worsening humanitarian situation. We've spoken about 1.2 million people being displaced, in addition to the political stalemate that exists in the country with no actual president. So again, all of these things are swirling, and for now, it just seems like further escalation.
Okay, Bloomberg Horizon's Middle East and Africa anchor Jemana Basachi in Dubai. We thank you. As traders continue to mine that geopolitical situation, WTI crude higher more than 1% now. Brent higher 0.75% at $78.65 a barrel. But coming up on the programme, ramping up the media appearances with less than a month to go. Kamala Harris and Donald Trump stepping up their campaigns. I'll bring you all the details next. This is Bloomberg.
Welcome back to the opening trade. 53 minutes into today's session, Monday's session here in Europe. And we see losses across European equity markets, in particular on the German DAX, where we're down 0.3%. Now, it is now less than 1 month until the US presidential election. Vice President Kamala Harris is ramping up her media campaign with a blitz of TV and podcast appearances lined up over the coming week. This comes after Republican rival Donald Trump and former president rallied supporters in Pennsylvania over the weekend, with Elon Musk joining him for the event. Let's bring in Bloomberg's Bill Ferries, who's monitoring all of the action ahead of the election. Bill, what does this flurry of media appearances mean then for Harris?
Well, if you remember that first month after Harris became the Democratic candidate, there was a lot of criticism that she wasn't appearing before the press, she wasn't doing unscripted remarks, and she wasn't doing kind of press conferences. She's starting to chip away at that reputation at this point. Still largely doing more niche audiences, going for niche audiences, podcasts. She's done the Call Her Daddy podcast, talking about student loan repayments, so going after a younger, more female audience there. She's doing The View, which is arguably an older female audience. She's going to do the Stephen Colbert show, things like that. Not a lot of really kind of hard-hitting interviews, but a way to get out there, field some questions, and probably really target those audiences she's trying to make sure turn out next month.
And as Anna mentioned, you had Trump returning to the site of the first assassination attempt. I wonder, Isn't that just going to shore up the same sort of support that he already has on board? Should he not be following the Kamala Harris strategy and taking a leaf out of Taylor Swift's book and going for the Gen Z vote?
Well, I think, he's campaigning. That event was in Pennsylvania. That's probably the most important of the battleground states. So I think both sides over the next 4 weeks are going to spend a lot of time in that state. I think Trump is going to have a similar media strategy. He's probably going to be doing more Fox News and other like podcasts, friendlier interviews. Both sides trying to make sure their key constituencies turn out in November.
Bill, thanks for the update. We're going to watch with interest. Obviously, we're less than 1 month to go until that election, that critical election for not only America, but the rest of the world. Bloomberg senior editor Bill Farris joining us. Let's talk about what we've got coming up for the rest of the week. Look, China's back tomorrow, and apparently we've got a really big briefing that is going to further augment some of the efforts that we made thus far to signal that Beijing is serious about its stimulus. That could be a key event. But what is going to be the big volatility event of the week, I think remains an open question. You've got China, you've got Fed minutes, you've got a lot of US data in the form of CPI, and then we get to the earnings picture as well at the back end of the week. Which of these kind of events is going to dominate, or will it be the geopolitics and what comes out of Israel and Iran?
Depending on what Israel does, perhaps.
Yeah.
And the French budget as well, as he's been reminding us of the need to focus on that. But yes, tomorrow I am taken by the detail. What detail will we get from the China National Development and Reform Commission? They are holding a press conference tomorrow.
What a great name.
We will certainly be there for all the detail on that one. And then as we get towards the end of the week, of course, we get bank earnings. Back to that story. As Maria Veitmane was telling us, it's high time we focus in on that.
Yeah, we also get GDP out of the UK on Friday, expected to point to the health of the economy. And as I say, now that Keir Starmer's got a new chief of staff, is he going to start pointing to the health of the UK economy after all the doom and gloom of the summer? It's a way to frame
Different
that
message.
budget at the
Different
end of the
message,
month.
maybe.
From the Treasury, from number 10 Downing Street, maybe 2 different messages coming out. Lisa is over here tomorrow. She's going to be talking to Jamie Dimon as well. Let's not forget that. So that's it. The opening trade. We've set you up for the week. Francine is next. The Pulse is coming up. This is Bloomberg.